And back here in the United States, Republican presidential nominee Donald Trump has lashed out at Google in his latest interview. Speaking to Fox News, the former president accused Google of deliberately censoring information about the U.S. presidential race.
Because Google uses its dominance in one area to succeed in another, it's not a level playing field.
Google and Microsoft are shifting production overseas, and they're doing it in plain sight. They are working, similar to every other company, to look at what they should do.
Google has accumulated unprecedented power over communication and information online.
I think it's quite possible that what we see come out of at least one of these cases is a breakup of Google.
But Trump sees what's coming, and he's not backing down. His theory is that if the tariff is made so high, so horrible, so obnoxious, companies will come right back to the United States. The tech giants are ready to abandon American workers for foreign profits, but Trump is about to make them pay a price they never saw coming. Will big tech bow to his tariff threats or fight back with everything they've got? Let's find out. Google and Microsoft, once champions of American innovation and praised for reshaping the modern economy from Silicon Valley, are now relocating, diversifying, and outsourcing the very operations that made them legendary. And they're not doing it loudly, they're doing it strategically, quietly, and in ways that look like progress on the surface, but are gutting domestic potential underneath. As all this unfolds, one person is screaming into the void: President Donald J. Trump. What makes this story even more disturbing is that his reaction, as theatrical and chaotic as it seems, might have hit closer to the truth than most people want to admit. While everyone else pretended America still had control, Trump's unfiltered response showed what no one else would say out loud: that America is losing big tech, not slowly, not eventually, but right now. Let's start with Google. In an interview that went mostly unnoticed by the public, buried under a mountain of other tech coverage, Google Cloud CEO Thomas Curran was asked about the looming threat of tariffs and how they might affect Google's sprawling infrastructure. If you were expecting a strong patriotic declaration like, "We're investing right here in the US," you'd be disappointed. Curran gave a corporate masterclass in dodging the truth. "We're working similar to every other company to look at what we should do, but we've made a lot of enhancements to our models to make the cost of inferencing and the use of it scale," he said. Translated into plain English, Google is preparing. They're not waiting to see what happens, they're already adapting, and that adaptation doesn't prioritize the United States. In fact, Curran made it clear that Google's models and infrastructure are being co-engineered not to localize them in America, but to make them mobile, scalable, and less dependent on domestic components. This is the playbook. This is how companies globalize without saying they're globalizing. By building modular infrastructure, designing chips that don't require traditional US supply chains, and spreading server farms, AI labs, and engineering hubs across countries where wages are low, unions are weak, and regulations are optional. Curran didn't say, "We're leaving America." He didn't have to. The subtext was louder than words. And then came the proof. Because we co-engineer the model and the infrastructure, we're able to do an exceptional job with quality, cost, and latency. Not once did he mention workers. Not once did he say Ohio or Texas or Detroit. Instead, he focused on cost, latency, and quality. Let's decode that. Cost equals cheaper than paying American engineers. Latency equals physical distance doesn't matter anymore. Quality equals the product still working even when it's built elsewhere. Now, what about Microsoft? If Google is leading the stealth exodus, Microsoft is tiptoeing behind, but leaving tracks. Just months ago, the company delayed a $1 billion data center project in Ohio. $1 billion on ice. The reason? Market volatility and supply chain disruptions, they said. But the timing coincides perfectly with tariff talk, trade tensions, and fears of a broader global trade war triggered by US foreign policy. What they're really saying is, we're not confident the US is worth the risk. Let that sink in. Microsoft, a company that made its name shaping the American tech identity, is hesitating to invest domestically because the environment isn't stable enough anymore. Meanwhile, Microsoft announced a multi-billion-dollar investment in Malaysia for AI infrastructure. Let's get this straight. America on pause, Southeast Asia green light, full throttle, billions wired. Imagine you're a tech worker in Ohio. You've trained, studied, maybe even relocated, thinking that Microsoft's investment was your ticket to the future. Then, one boardroom meeting later, it's over. No layoffs, no protests, no headlines, just silence. Welcome to the new normal. And this didn't start with tariffs, and it won't end with tariffs. This shift has been years in the making. As early as 2016, big tech was already looking overseas, not just to save money, but to protect themselves. From what? From politicians, regulations, unions, lawsuits, and accountability. American workers are expensive. American governments are unpredictable. American voters are emotional, so companies build insurance policies. They open campuses in Dublin, test server farms in Vietnam, outsource entire teams to Bangalore. That way, when chaos hits, they're ready. Back to Trump. For all his theatrics, outbursts, and headline-grabbing speeches, he did understand something most people didn't. He knew big tech was slipping away. His answer was simple: tariffs. The higher the tariff, the more likely it is that the company will come into the United States and build a factory in the United States. Another theory: make the tariff so high, so horrible, so obnoxious that they'll come right away. He believed in tariffs like a preacher believes in salvation. But it didn't work. Google and Microsoft operate on data, not emotion. Their data told them one thing: it's cheaper and safer to leave. Even as Trump tried to bully companies back with 100% plus tariff threats, the exodus accelerated. They had an excuse. Sorry, America's unstable right now, we have to diversify. Boom. Southeast Asia wins another contract. While Trump roared about MAGA and America's rebirth, companies like Google quietly kept building out server infrastructure in Singapore. While Trump scolded reporters, Microsoft inked new deals in Indonesia. While the political class debated TikTok bans, Google trained 4 million developers across non-US platforms. Ask yourself where those developers are. Who's calling those APIs? Which countries are benefiting? If you think the answer is only America, think again. For the average American worker, this isn't just a policy shift, it's a betrayal. These weren't just companies, they were symbols. Google was freedom of information, Microsoft was access to opportunity. Now they're global profit machines with no allegiance to the flag. As we enter an era where AI decides who gets hired, trained, or automated, remember who built the infrastructure. It wasn't you, it wasn't your town, it wasn't your country, it was the country that made the best offer. As companies disappear overseas, Trump got louder, angrier, unhinged. His response was explosive. The United States was supposed to be the control room of global innovation. By the time Google and Microsoft started shifting production overseas, Trump's answer wasn't policy, but performance art. Tariffs became weapons. He didn't talk about them like taxes, but like bombs. The higher the tariff, the more likely the company will come back. His strategy wasn't based on economics, but shock value. For a while, it worked as theater, but not as policy. By 2018, Google was already building custom AI chips that didn't rely on foreign semiconductor markets. By 2019, Microsoft had announced new cloud regions across Asia, Africa, and the Middle East. These weren't reactions to Trump, but proactive chess moves. Trump tried to fight a wildfire with gasoline. The more chaotic his threats became, the more corporations looked at Vietnam, India, and Malaysia not as alternatives, but as future headquarters. Still, Trump doubled down. He bragged about tariffs, weaponized them, and lashed out when questioned. Even as companies expanded overseas, he insisted that China was begging to negotiate because we have $14 trillion now invested. For every action Trump took, other countries retaliated. Europe fined Microsoft repeatedly, and Google faced over $9 billion in antitrust fines. As Trump kicked the global hornet's nest, American companies became easy targets. Google saw it coming. Microsoft braced for it. The White House kept shouting. Trump claimed his tariffs were pulling in billions for the US Treasury, that companies were lining up to return. But behind the scenes, the factories remained empty, the jobs gone, the servers assembled in foreign labs. The ongoing shift of production by Google and Microsoft to overseas locations, particularly away from the US and China, reflects deep structural changes in the global tech industry. While these moves are driven by geopolitical tensions, supply chain resilience, and cost efficiency, They also highlight long-term risks to America's manufacturing base and innovation ecosystem, raising concerns about the acceleration of US industrial decline. Both Google and Microsoft, along with other tech giants, have increasingly relocated hardware production to countries like Vietnam and India, seeking to diversify away from China due to trade tensions and pandemic disruptions. In 2025, the tech sector saw over 100,000 layoffs, with Google and Microsoft cutting thousands of jobs across divisions. This restructuring is partly a response to shifting business priorities and operational models that rely less on domestic manufacturing and more on overseas production and automation. The imposition of new tariffs in 2025 further pressured US tech companies to adapt their supply chains, with Microsoft faring better than Google due to its enterprise-heavy business mix. However, both companies are actively adjusting logistics and considering more non-US manufacturing to mitigate tariff impacts. Historically, the US led in both tech innovation and manufacturing. However, as more R&D and production are conducted abroad, the synergy between innovation and manufacturing weakens. Experts warn that if US companies continue to innovate and produce overseas, America's ability to sustain technological leadership could be undermined. Apple's strategy of designing in the US but manufacturing abroad became the industry norm, reinforcing the notion that high-value activities could remain domestic while production was outsourced. This has contributed to a hollowing out of US manufacturing skills and capabilities. China's aggressive investment in both production and R&D has shifted not just manufacturing, but also innovation capacity away from the US, intensifying global competition and accelerating America's relative decline in industrial leadership. Despite these trends, the rise of generative AI is projected to substantially boost US productivity and GDP, potentially offsetting some negative effects of manufacturing decline. By 2038, generative AI could add $3.8 trillion annually to US GDP, driven by higher labor productivity and business innovation. However, the benefits of this AI-driven growth depend on effective workforce reskilling and maintaining a robust domestic ecosystem for both innovation and production. The shift of Google and Microsoft's production overseas is both a symptom and a cause of America's manufacturing decline. While these moves may enhance supply chain resilience and corporate profitability, they risk further eroding America's industrial base and innovation capacity. Unless countered by new policies or investments that reconnect innovation with domestic production, this trend could accelerate the relative decline of US economic and technological leadership, even as AI and digital sectors offer new sources of growth.